You may have heard Warren Buffett recommend a low-cost index strategy, also known as a passive strategy, for many long-term investors. He was referring, of course, to investing in stock market indexes. You're probably already familiar with this method when it comes to equities. But what about using a passive strategy for fixed income investments? Is it just as effective for individual investors? Hi, my name is Guillaume Perrault, Portfolio Manager at Claret Asset Management. In this video, I'll walk you through how indexing works with fixed income products, how it's different from stock indexing, and why it may not be the best strategy for individual investors. What is indexing in fixed income? Indexing means investing in products that aim to mirror the performance of a specific market index. In the case of fixed income securities, this involves investing in funds made up of many different bonds and structured products that follow a particular bond index. There are many bond indices out there. The most common ones attempt to represent the entire universe of fixed income products available in the market. This includes a mix of federal, provincial, and municipal bonds, as well as corporate and even foreign debt. Two key differences from stock indexing. There are two key differences between indexing with fixed income securities and indexing with stocks. First, the weighting problem. When following a stock index, for instance, a cap-weighted index such as the S&P 500 or the Nasdaq, your investment is proportionally allocated based on the market capitalization of each company. That means you're putting more weight into companies that the market, at that moment, considers should be worth more than others. That makes sense. But with fixed income indexing, you're investing more heavily in issuers with the most bonds, and in some cases, those with the most debt relative to their assets. In other words, those that owe the most get the largest slice of your investment. Governments and companies issue bonds to borrow money. Borrowing money in itself isn't necessarily bad, but when a borrower takes on too much debt, it can eventually affect their ability to pay it back in the future. Ask yourself, would you feel comfortable lending money to someone who already owes 10 other people money? Probably not. The second key difference is institutional needs versus individual needs. Bond indices were designed to represent the specific needs of institutional investors, such as pension funds and insurance companies. These institutions have very specific needs. They require liquidity and must plan for cash outflows over different time horizons. So their portfolios need to cover a wide range of maturities. But as individual needs are different, the selection of certain fixed income products can be more tailored to your situation. Say you're investing for 5 years. Depending on the yield curve, you might not need to hold both a 3-month T-bill and a 30-year Canadian government bond, as indexing strategies often do. Combining a few municipal bonds in a portfolio could be more suitable for your needs and offer a better return. Tailoring fixed income, the bottom line. While indexing can offer diversification, especially for smaller portfolios, it isn't always the most effective way to meet your specific goals. Individual investors often have defined timelines and unique risk profiles. A more tailored strategy, built with carefully selected bonds that align with your needs, can help optimize returns and reduce unnecessary risk. But selecting the right fixed income products requires knowledge and discipline. If you're not sure which path is right for you, that's where we can help. For more investment tips, go to claret.ca and don't forget to hit the subscribe button below.